I think there are some legitimate public policy questions about the general explosion of derivatives in general. Gensler has raised this issue many, many times, and I think that's the subtext of what Rubner's trying to say.
That was a great report. Thank you. I wanted to ask you if you think the time of year that we're in is really giving this type of activity more of an emphasis than it would otherwise have. And just to put some meat on those bones, 1.86 million zero-day contracts traded hands at the end of last week. That's about 55% of total index volume. That's Nomura data. So it is a lot of activity. But then the other side of that would be to say, yeah, but it's a ripple in the pond. It's market makers. They do their delta hedging. They get it done by the end of the day. It doesn't really move things that much outside of the effect of 1 or 2 hours. What is the right way to think about that?
It is a good point at a time, seasonally, here we are. I mean, I looked up at the volume here at the New York Stock Exchange yesterday.
Pretty poor.
Almost at the end, it was like 400 million plus shares. Normally, we're over 1 billion, right?
800 to 1 billion. Yeah.
So
here's the question. What's the subtext here? Did this trading actually cause some of the recent swoon? And I think the answer is no.
You don't think so?
I think that, look, when you get volatility, it increases options trading by definition. So what tail wags the dog here? Does volatility cause options trading, or does options trading cause more volatility? Generally, when volatility moves up, particularly towards the end of the day, you'll have more trading that's actually going on. So I don't think it was a huge part of this. No, I don't think that. I think it's wrong to say that there's perfectly good reasons why we've had a swoon in the last couple of weeks that doesn't have anything to do with whether people are engaged in options trading. To your point,
the biggest days of this were days with economic data. The biggest days of this activity
that would make sense,
payrolls on August 4th, CPI on August 10th.
That's when traders wake up and say, oh, I have a bet on the direction of the market.
They'd be trading
you would think the volume would be heaviest on those days.
We're so fortunate.
There's other reasons why the market's down.
We have so many different kinds of folks on the investment committee, people who do different things and have different strategies and use different methods in the market. Bill Baruch, by the way, I remembered saying a day on this show that you use zero-day options.
Yeah, I'm working on some strategies right now to implement these. It's as the market always evolves, you have to stay on top of things. I mean, I've been trading for nearly 20 years, and my strategies have evolved, year in and year out in order to stay on top of things like these zero DTEs that are coming out right now. I think they have a pretty solid impact. I think everybody that has spoken here at the investment committee just now has made a good point. I mean, seasonally, there's a lot of uncertainty. Josh spoke about the rate of change in the bond market on specific economic data days. You want to take a defined risk. And that's where these become a really good tool, is either hedging with a defined risk through a certain day or taking a defined bet for direction. Now, where some of the problems can come in is late in the day. You look at yesterday, where the Goldman analyst spoke of that final half an hour. I mean, one thing from my studying of these zero DTEs I've learned is sometimes the bid-ask can really widen up, and as liquidity starts to dry up a little bit on these specific options. So if somebody starts hammering some of these, it really, on the other end of it, the market maker is sort of exacerbating what he has to do late in the day, too. So there is some tail that wags the dog at times. But at the end of the day, too, we're also in a very big time of uncertainty right now. And being able to take defined bets day to day and use these as a tool, you would hope that this could be an advantage.
Bill, independent of all of this, whether it actually moved markets at the close in some of these more volatile days, is it a legitimate public policy question to ask about the proliferation of derivatives products in general? Gensler, there's been numerous studies about the explosion of derivatives in general. Is there any legitimate concern about that? And could it eventually become an issue where the tail does essentially wag the dog?
That's a tough question to answer. I've spoken with people who are, behind the scenes here making some of these and trying to get what their thought process is. And really, what they're trying to do is add more tools, advance their products. And right now, I think it is a good thing. I mean, there's obviously some concerns from time to time, but what the liquidity could be and what the impact is going to be. I think it's a good study. I think the regulators should continue to study it. But as trading evolves, as electronic trading evolves, and I think these tools need to evolve with it. And as a trader, you got to stay on top of your game and evolve too. That's what I'm trying to do right now and understanding these as best I can.
Yeah, Bill, I appreciate you coming on very much, helping to at least add some clarity to what we're talking about, and not being suggestive in any way that this was an overwhelmingly large part of why some of the volatility was there. But nonetheless, it's what some people are talking about. We wanted you to explain it, and you did. And
when Gensler talks about gamification of trading, this is some of the things that he brings in, the explosion of derivatives. So there's a broad, interesting public policy philosophical question.
All right, Professor Bob, thank you. Okay.